This is what's scary. Canadian Warren Buffett say tech stocks are more overvalued now than during the dot-com bubble. Very common question that we get, everybody asks is, are the markets overvalued, undervalued, fair valued? This is something that this question I use when I meet an investor. I ask them this question, not because if they answer yes or no, that it's the right answer or wrong answer. We really don't know the future. We have no clue what's going to happen in the future. But what we can do is we can look at the past and determine based on the past where we stand in relation to history. And the other thing is, when I ask this of other investors, my thought process is to see what their thought process is there. Years ago, I'd have people say, oh yeah, stocks overpriced. I'm like, yeah, I agree. Why? Oh, it's just run up so much lately. Well, that's not a reason that stocks are overpriced. Just because something goes up very fast or down very fast in a short period of time, in and of itself does not make it overpriced or undervalued. All it says is sentiment changed for whatever reason in the short run, and people accounted for it. That's it. Now, what I like to do, and something I do in our community, I have my own stock market to GDP ratio. There are two major metrics that I look at. There used to be a third one, and I still look at that one. But the two major metrics I look at are the stock market to GDP ratio and the 10-year cyclically adjusted PE ratio. Now, let me explain these real quick. The stock market to GDP ratio, Warren Buffett says at any given time, is probably the most reliable metric on where we stand at any given moment in terms of valuation. Now, are there some criticisms of that? There's always going to be criticisms of every single metric out there. And the most common criticism I hear, and I've been hearing a lot lately from even people in our community, has been, Paul, as we become more service-oriented, the margins are going to be higher and we should be willing to pay a higher price for that. And I don't disagree with that logic. I've said it myself. But I just feel like there's so many things that are working at any given time that it kind of we're also not looking at the things that probably affect the stock market GDP ratio to the negative. The point of them is not to sit there and say this is the exact science. It's to say, generally speaking, where do we stand? So let's pull up my personal stock market to GDP ratio. And again, every single morning in our community, I announce this ratio based on the previous day's closing price. And as of right now, as of Friday's close, we're at 4,079.09, gives us a ratio of 1.561, which based on data going back to 1929 that I pulled, we are 67.6% overvalued and a fair value of roughly 2,400. Now, is this an exact science? Of course not. It isn't, and it never will be. But starting at 4,080 to 2,400, that's such a big difference. It's hard to get around that. And this does not include dividends. So the next 10-year returns on average since 1929 has been 6.6%, which makes sense because dividends prior to 1995, 1990 were much higher than they are today. But when we're undervalued by 30% or more, the average is 10.9%. When we're even, it's all undervalued is 9.3. All overvalued, the average is 2.3% a year for 10 years. And obviously the more overvalued you go, the worse it gets. So based on where we are today, we can expect to, based on history, 37 times in history, we can expect to have the S&P end up negative 0.5% per year worse over the next 10 years. All right. Now, how bad is it really? Well, let's go look at 2000 and the tech bubble boom. So back in the 2000 tech boom, we hit a valuation high of 56.9%. This is what's scary. That is higher. We are higher today than it was back then. In fact, an article that we pull off our website on a Market Watch, Canadian Warren Buffett say tech stocks are more overvalued now than during the dot-com bubble. This popped up on our Everything Money, and I went to the main Market Watch page. It's the main article right there. Now, a lot of people will talk about this, and everybody has their opinions. And during market booms, everybody's like, well, that's wrong. This doesn't apply. The whole idea is it's different this time. Okay, so the stock market to GDP ratio, I get it. It might be a little bit harder, but you look at correlation in history, it's a very, very high correlation. The correlation is a negative 0.81. That's a very strong correlation. That means it's inversely correlated. The higher the GDP, the ratio is, the lower the returns. Negative 0.81 is a very strong correlation. So let's look at another metric, the 10-year cyclically adjusted PE ratio. What that does is it takes the last 10 years of profit in the S&P, brings it to today using inflation, brings it all into today's dollars, and divides the current market cap by that, by the current price by the earnings. And we're currently at 29.16. Not as bad as the tech boom, where we hit 44, but still pretty bad. And this does account for higher earnings per share, because it's all about earnings per share here. Now, the historical average going back to the S&P equivalent back in 1870 is 17. The median is 15.9. That means half the time it's above 15.9, half the time it's below. The low was 4.78 in 1920. And look, lows go up, lows go up, lows go up, go up, go up. That's the point, guys. When you pay less, you make more. That's the key. Now, these are the two that I consider to be the most reliable indicators because they factor in market cap, they factor in earnings, they bring in inflation, all these things together. When I look at the average of 17 and we're currently at 29, boy, that's a hard thing for me to say. No, we're fairly priced. There's going to be a million reasons why people will say that. But our belief is that right now, the stock market is grossly overvalued. We saw the start of what we consider to be a bear market for a few years that will have to weed things out. Things were too easy for investors. When you have young kids talking about crypto and Tesla, and these are the only stocks you need to own, the only investments you need to own, that glares to me as obvious times that you need to be careful. Now, this is probably a little bit different than a lot of people on YouTube are saying, and the reason being is they need to make videos to make you feel good so they make money. Our goal here is to sit there and be absolutely honest with our opinion. I have emails from back here when I was telling people, buy stocks. This is great. I'm not a perma bear. I respond to valuations. I absolutely always respond to valuations. And there will be a time, mark my words, I've said this in many videos in the past, there'll be a time when we're telling people, you need to buy stocks and stocks will continue going down. And our criticism will be, man, you say to buy these stocks and they're great values, but they keep going down. Buy some more. Stocks are not going to zero. Will some stocks go to zero? Absolutely. But if you dollar cost average into long-term ETFs, you will do well over a long period of time. And here is why. The market's value goes essentially up like this, but here's how the prices of the market go. Your job is to buy all along the way. You're going to overpay, you're going to underpay, but over time, you're going to match the market. So stop paying some mutual fund company or some financial planner a ton of money to charge you fees for you to do better than them because they don't beat the market. This is extremely important. We are absolutely overpriced today compared to history. We absolutely will have a harder time making money, good returns over the next 10 years. Now, are there some stocks that'll do well? Absolutely. But we never know where the bottom's going to hit. So when you find a fairly priced company, that's a good company that you want to own, you buy it. And if it goes down, if you have the ability, you buy more. That's the key of what we're trying to teach here. So if you like this, subscribe to the channel. And also, if you like our software, everythingmoney.com, $7 for 7 days. We're running a special right now. Take a look at it, $7 for 7 days. Also, send this to somebody who needs to hear this. Whether it's somebody who thinks the world's going to be perfect for the next 10 years or somebody who's very worried. The point is, this will cause you to be more calm about the future because things will always get better because the United States and the world will get wealthier and wealthier as time goes on. Thank you.